Today we have with us the co-executive chair of one of the largest private markets asset managers in the world. Welcome to Mario Giannini from Hamilton Lane. But I'm going to introduce you to Mario in just a moment. I'd like to set this conversation up with a chat with the head of private markets at LGT Crestone Wealth Management, Martin Randall. Just a reminder that some of these strategies that we will uncover today are only available to sophisticated or wholesale investors. So mind the disclaimer. All right, let's get started. Welcome. Thank you so much for joining us.
Thank you.
Now, this seems very basic, very big, but when you are talking about private markets at LGT Crestone, what are you talking about?
Well, in a nutshell, everything that's not really public. And that may sound a little bit simplistic, but I think the realm of alternatives and private markets as a component of that can get a little bit overcomplicated. But you think about private markets, you think about private equity, private debt, venture capital, which is early stage companies. You can even expand that to private real assets as well. So unlisted infrastructure, unlisted real estate. So things that are not listed. When you think about real life examples, these are companies we use every day, but you just can't buy them on an exchange, whether it be the S&P 500 or the ASX. You just buy them and own them in private ownership instead.
So it's my understanding that private market allocations now account for about 20% of assets under advice at LGT Crestone, roundabout there. So what's behind the accelerated growth? Like, how has your clients' demand been evolving?
Well, if you take a step back, the demand for alternative assets has been growing for many, many decades. So it's not a new phenomena. The thing that has changed specifically for our client segment, so high net worth, ultra high net worth, family offices, smaller institutions, is really the access point. That's the bit that's really changed. And over the past 5, 10, even 15 years, you've seen an evolution of the way that our clientele can actually access private markets. And so what has historically been a domain of the institutional investors globally, so think sovereign wealth funds, pension funds, is now accessible to private clients more broadly. And that's really been what's accelerating that growth.
Look, evergreen private markets are dominating flows, even to the expense of more closed-end structures. So, I mean, just educate us. What do they mean? What do they do? What role do they play in a diversified portfolio?
So evergreen is sort of the terminology, also referred to as open-end funds. In a traditional sense, so public markets, anything you buy, whether it's an ETF or a global equity fund or a global fixed income fund, is evergreen in nature. All that really means is that you can buy something today, be fully invested, and sell something at some point in the future. Historically, the private markets universe has been accessed via a closed-end structure. So you make a commitment, that commitment gets drawn down over a period of time, and then capital gets distributed as and when underlying investments get sold or there's some form of distribution from those investments. The translation that's occurred over the past 15 or so, or 10, 15 years really, has been that we now have open-end or evergreen vehicles in the private markets, which makes them more accessible to the way that we build portfolios. And so for us to be able to access private markets in an evergreen construct, it's a lot easier for the way that private clients allocate capital relative to institutional capital. There's two components I would pull out. Most tend to focus on the liquidity component, i.e. when I can get capital back. And that's the key innovation. How do you get liquidity out of an asset class that's inherently illiquid? And we can touch on that a little bit more. But the key innovation from my perspective and why I think it's been, this growth that you've seen has been there is actually what I call the inbound liquidity. Our ability to say, I want an allocation to private markets of 5, 10, 20%, whatever that number may well be, and actually invest fully today and get that inbound liquidity into a diversified portfolio. So the mechanism by which we can build private markets allocation has fundamentally shifted, which is really growing allocations in high net wealth client portfolios.
Yeah, and we'll be exploring a lot of these topics sort of throughout the next couple of hours. But to your point about liquidity, I mean, that is one, I don't know if it's a concern, but it's something that you need to be cognizant of as a wholesale or retail investor getting into private markets.
Absolutely.
So flesh it out for us a little bit.
So first and foremost, if you think about public markets, you buy a stock on an exchange, you sell a stock on an exchange, T+2, you get your capital back. You know generally where you stand. Same with an ETF. With privately negotiated transactions, there's no exchange. It takes time to negotiate these things on the way in and on the way out. So the assets are inherently not liquid. So when you bring them into a structure that provides some level of structured liquidity, and structured is the key word there, you sort of see semi-liquid or liquid private equity. It's not strictly true. They're not inherently liquid. But when you bring something into a vehicle that provides some level of structured liquidity, you have to question, where does that liquidity come from? And I think about it in a couple of ways. So one, the level of diversity you have at the underlying position. So I've got 100, 1,000 underlying portfolio companies. And this concept of a vintage. When did you buy that company? When did you start that value creation cycle that is inherent within private equity? If you have a combination of both, you have a highly diversified portfolio at different points in their life cycle. What that means is at any given year, the portfolio should naturally turn over. Private equity firms want to sell companies. They will sell companies. And so if the portfolio is diverse enough across those two factors, issue and vintage, it will create liquidity. But it's not the same as public market liquidity. So as long as the structure is set up, the diversity is there, and it's built in a way that is understood, then it can provide some element of structured liquidity through the cycle.
So when you are selecting best-in-class managers at LGT Crestone, how important is scale when you are considering those managers?
Scale is important. So, very large firms can do certain things. They can deploy a lot of capital, and then smaller firms can play in, let's say, less competed markets, for example. There's a couple of ways to unpack it. I think with regards to the evergreen conversation, the scale piece comes to effectively deal flow. If you are a firm like a Hamilton Lane, for example, a significant allocator to the whole private markets ecosystem, that means that you get the opportunity to assess multiple private equity firms, multiple deals, whether that's co-investments or secondaries or primary funds, which enables you to build a diversified portfolio, which helps fund that liquidity component that we can dive more into as you see fit. So scale in the context of an evergreen portfolio is mission critical. Scale in the context of a direct private equity firm, it's just a case of, well, what part of the market do you want to access? There will be times where a mega cap buyout strategy will be a fantastic place to be. There will be times there will be more inefficiencies in the smaller cap segment of the market. And so that really comes back to how you want to build the portfolio, where the opportunities are at the individual fund level.
Martin, we will come back to you in just a moment, because speaking of scale, one of the biggest private market managers in the world is Hamilton Lane, with almost $1 trillion, with a T, US dollars under management and administration. It is just one of the managers on the LGT Crestone docket, and we are very thrilled to welcome co-executive chair of Hamilton Lane, Mario Giannini, to the studio. Mario, welcome. Thank you so much for joining us.
Good to be here.
So alternatives under management, just growing exponentially over the past couple of decades. What is underpinning that growth in your view?
Well, the basic factor is that if you look at over the last 25 years, alternatives, whether in equity, credit, real estate, all of the different alternative classes have outperformed the publics. There are other reasons, but fundamentally, it's a question of outperformance. So if you have this set of assets that's been outperforming for this period of time, people want access to those and exposure to those in their portfolios.
And when you think about some of the risks that are facing equity investors now, for example, US-China tariffs, how does the macro play into the view when it comes to private markets?
Oh, it comes into play. One of the great myths, if you talk to private market people like me, what they will say is, oh, we're not subject to the public markets. We're smarter, we're better, we're all these things. It's just not true. We are as subject to the macros as everyone else. I think the difference is a few things. Number one, in the public markets, you are really subject to the whims of a lot of other investors. Whereas in the private markets, I am making a choice to invest in a company, to invest in an asset. I have a lot of time to make that decision, and I am there with that asset, able to control it. While the macro matters, I have such a degree of control around that asset that the effect is muted compared to the ups and downs you see in the public world. It's just a very different kind of ownership of an asset.
And so there's no shortage of these opportunities, even as private markets continue to develop and evolve?
Yeah, the thing I've heard my whole career, so I've been at this 30-something years, and the only virtue of being old is that you kind of hear some things over and over and you go, hey, I've heard this before, is it true? I've always heard the private markets are getting too big and there won't be enough opportunities. And it just hasn't been the case. As the private markets have grown, so too has the opportunity set. More people are aware of private markets as a way to exit a deal, as a way to get financing. And so they've kind of grown in lockstep, the amount of capital and the amount of opportunities.
And retail investors are obviously driving a lot of the growth in private markets. Some, though, have said that the golden era, so to speak, of private markets is behind us. So how does Hamilton Lane position itself when it comes to, the democratization of these markets, so to speak, but also performance and discipline?
Well, I mean, there's a couple of things around that. The first is, yes, the retail high net worth space has become a bigger player in the last few years. But when you look at it, it is still, 10, maybe 20% of the total. The institutional market is still the largest part of that market. And I don't see a time when that is going to fundamentally change, where the retail becomes bigger. So this notion that all of a sudden there's so much capital and it's dwarfing what's been available before is simply not true. So I'm just not that concerned about it. What it does mean, though, is that you have to, as Martin has indicated, you have to provide structures, because individual investors are simply different from institutional investors. They operate differently. They don't have a giant staff the way, for example, some of the big sovereign wealth funds have. So structures and ways of investing have to evolve. The fundamental kinds of investments you do are not changing. The kind of deal that is interesting to a sovereign wealth fund is the same kind of deal that is going into the retail evergreen space. So I don't think the nature of private investing is changing. The structures available to access them, as Martin has pointed out, are changing and developing.
What about the systemic risks? So we talk about valuation. For retail and wholesale investors, it's not as clear to them oftentimes. Yeah. Valuation, there's cyclicality, there's leverage as well. So how do you sort of manage that and those risks at Hamilton Lane?
Look, one of the things I think we all have to be clear about is that the risks of investing in private markets are the same for individuals as they are for institutions. Liquidity, we've talked about. So I'll say this about liquidity. Liquidity is your greatest enemy. People want liquidity, and they want it so they can make their biggest mistake. They can sell when they shouldn't, and they can buy when they shouldn't. That's what you want liquidity for. Nevertheless, you have to go into private investments with the idea that liquidity is not the same as public. You may overemphasize the amount of liquidity you want, but it is a risk. The risk of valuation, in my view, is overblown. Private market practitioners are used to valuing assets, and they've done a pretty good job of it for 30 years. If there was some systemic problem with valuations, we would have seen it in our industry over some period of time in that 30 years. So the risk, I will say though, I do worry a little bit about the first bear market with the individual investor. They've not gone through one. How will they react? I suspect they'll react the same as they do in the public markets. They'll panic, they'll get worried, they'll want to get out. And I think that's when we'll see whether they have the patience to be in illiquid investment or more illiquid investments.
So we've discussed how advisors like LGT Crestone determine which managers to recommend. So in turn, how do you identify at Hamilton Lane and capitalize on opportunities across private markets?
Well, I think the biggest difference to me between public and private markets, if you're an investor, is this issue of diligence. So I'll give a plug to Martin and his team. We work with advisors, managers around the world. The best ones are the ones that have a disciplined structure of looking at investments. LGT Crestone is as good as we see in the world. It's not only when you look at the investments, what they do really well, which I think investors need to have help around, is how does it fit in a portfolio? what do I need in my portfolio relative to everything else I have? That is not a trivial task. I don't think that either institutions or individual investors, unless they have a huge staff, can really do this on their own. And it's the same for us. I mean, we have hundreds of people who do nothing but look at investments and then figure out how they fit in a portfolio. That is what is different about private markets. You can't just pick up, the Financial Times or the Wall Street Journal and go, oh, hey, this looks like an interesting thing. I think I'll do some research on it. Doesn't work that way. You need someone like an LGT Crestone, a Hamilton Lane, somebody to help you that knows what they're doing. If you don't have that, challenging, really challenging.
All right, Mario, thank you. And I think on that note, it's probably apt to bring in Martin Randall again from LGT Crestone. We just heard Mario addressing some of the risks, because we do hear that a lot as wholesale and retail investors, that you need to be very cognizant of liquidity valuations. Do you have anything to add on the valuation piece? Because it is difficult for those sitting at home to fully understand perhaps even what they're invested in.
The valuation one has always been an interesting debate. I'd echo Mario's comments in that the practitioners of private markets across different sub-asset classes of private equity, debt, the real assets component as well, have been at this for many, many years. But the interesting thing is they're still valuing things as you would do, at least from an analyst perspective, as a public market analyst would do. The difference is that you just don't have that sentiment swing. And you sort of saw it if you take 2022 as an example, you had a terrible time for public markets across equity and debt. Private markets weren't immune. But you just didn't get that huge sentiment swing. So you think about the excesses that we saw in 2021, public markets and private markets rose very strongly. And then you saw the reverse in 2022. And so I don't know where buyout ended up at the end of 2022, but on average down sort of 5 to 10%, whereas peak to trough, the public markets was down, let's say 20-25. And then different segments of the market react different ways. So venture capital and the earlier stage contingent was down harder in the same way that public technology was down harder. So the second you remove that sentiment, it is a smoother journey because you're not marking to market every day. And so the second you understand that the same underlying economic factors still exist, the same risk is there, you just don't see it as much. And the second you put that into context, that's the important piece, and that gets missed.
Mario, how do you see the balance between public and private exposure in sophisticated investor portfolios globally?
Well, we've seen over the last, I'll call it 15 years, we've seen allocation to private, on the equity side, for example, increase from what it probably 15 or 20 years ago was 5% to now I would say on average 15, 20%. And so you've seen it increase. And I think it's driven again by performance. The other thing it's driven by, so a few years ago, I got a call from the head of a big US pension plan. And he said to me, Mario, I'm going to increase our allocation to private equity. And I said, why are you doing that? You hate private equity. You hate us. You think we're greedy, awful, terrible human beings. And he goes, you are all that. That hasn't changed, my view on that. But here's what is different. Right now, and I look at my portfolio, there is a huge swath of private companies that are not coming public. And I need exposure to those. That is getting even worse than it was a few years ago, in the sense that if you say to me that OpenAI getting valued at $500 billion in the private world, you have no ability to get exposure to that in the public world. So it seems to me that as an investor, if you want a full allocation to the range of companies out there, more of them are staying private for longer. And so your allocation has to include that, and it has to be private.
And is there any sort of a bias right now toward the US exceptionalism, the whole AI story? You've just made me think of that. Or, are there other opportunities around the globe emerging, or has it always been?
Today, we won't make this political, which I'm happy to go down, but I don't think we want to. Today, the reality is if you want a significant AI exposure, and I think you do, you either invest in China, which is very difficult, or you invest in the US. There are no other parts of the world that provide enough exposure to AI and all of its different parts. So I don't know that it's US exceptionalism, but it is a reality that in today's world, to get the exposure to AI in all its different forms, you have to be overweight the US.
I think that's a good point to delve into, because I think it's been easy for investors to focus on some of the comments that Mario made earlier around the performance piece, sort of decades of how private markets have performed. The bit that often gets missed a lot is the broader portfolio piece, which is what Mario just said, which is only growing in one direction. And so the breadth of opportunity in the private markets, i.e. companies that just aren't publicly owned, is so much broader and is only getting bigger. So public markets have been shrinking for many decades now. And then specifically when you look at company formation, the only way that you can get access to true company formation, whether it's an AI startup or another tech business, is in that venture capital landscape. And because there is a far greater pool of capital now coming through stages from early stage to late stage to growth to buyout to IPO, to go on that journey, you can't buy Amazon 2 years after its foundation back in the day. You buy that 10 years after. I mean, look at the local market darling Canva. It's 2011, 2012, it's still not public. And it's a top 10, top 20 ASX company if you put the market cap there. So that bit gets missed and is very important if you look at what does the future portfolio look like.
And that's why we love doing this event every year, 4th year running. I think I mentioned that already. So given LGT Crestone's focus on sourcing and structuring these bespoke solutions for high net worth and ultra high net worth clients, what specific market opportunities are you really most compelling in your view right now?
At the moment, we've been focused, well, certainly over the last 12 to 18 months, we've been focused much more on the private debt and the unlisted infrastructure opportunity set. There's been a lot of noise around private debt locally, but private debt is a huge market globally. There's an assumption that it's still relatively new, but it's not. It's continuing to grow, and it is going through the process that private equity went through 5-10 years ago in terms of its accessibility. If you actually look at the data, and Hamilton Lane produced a lot of the data on this, the performance comparisons relative, public equity relative to private equity and public credit relative to private credit is even more compelling in the private debt landscape. And so that is a more defensive component of portfolios relative to private equity and venture capital, which is growth. And because that part of the market has not been accessible, that's something where we've really been driving allocations to. And then the infrastructure universe, again, it's going through that translation exercise that we've seen in private equity.
Fascinating. Look, we will try to get to a couple of your questions that have come in, but Mario, where in your view do retail investors get it wrong, go wrong when it comes to private markets or alternatives in general?
They get it wrong for the reasons we talked about. They get it wrong on the public side. They think that it is something that they'll get into for 6 months and they'll be thrilled and then they'll get out and move in and out of it. They'll use it as a trading vehicle and they'll be colossally wrong. Look, we're all closet market timers. We all believe we can do it. I believe I can. Empirically, 30 years tells me I'm absolutely wrong on that. That's where they get it wrong. I hear all the time, is now the time to invest, with the sub question of markets too high, markets too low. If you're going to be in alternatives, and I think you should be, pick your allocation amount, put it in, and just stay with it. I mean, don't look at it as a crypto thing. You're just going to kind of get in and out because you think you're really that smart.
You'll be humbled. All right. Just let's get to a question because I know that we have a few more coming in. So I'm reading a lot about equity managers using AI to research source stocks, especially in small caps. Are you using AI in private markets at all at Hamilton Lane?
Yes. But what I will say is we're not using them to make investment decisions or using AI to make investment decisions. Now that you've heard me, you might say perhaps you should. But where we're using it a lot is it dramatically increases the productivity around getting basic reports together, getting anywhere where you have a bunch of data, which you do when you're analyzing investments. AI makes it so much faster and enables you to then make I'll call them the more important, involved decisions around, what do you think the market's going to do? What do you think this manager's going to do? But sure, and I would imagine that this will continue to increase as AI becomes more advanced around making inferences, making decisions. But right now, we do not have it making investment decisions. I hear people say, well, why not? And the answer is it doesn't do it very well.
Yeah. Well, listen, we're out of time. Martin Randall from LGT Crestone, thank you so much. Mario Giannini from Hamilton Lane, Co-Executive Chair. It's been a pleasure to have you here. Thanks for visiting.
Thanks.
Thank you.